Ladies and gentlemen, the retail apocalypse is about to get much worse. Experts are warning there's going to be 50,000 store closures, all because of a new alarming trend. I don't know about you, but when I walk down the street, I'm starting to see more and more empty shops, and I'm starting to see a lot less foot traffic in these stores. And what this is causing many people to become concerned about is this is going to destroy our small stores, small mum and pop stores, and it's only going to end up being a few large giant retailers. They'll be able to charge whatever price, or they'll be able to do whatever policy, like what we're seeing with Target right now, and there'll be nowhere else for people to go. So we're going to cover this in today's video, but also some very important things that happened on the weekend, like what happened with the latest jobs report that was completely cooked. We're also going to go over what's really behind the stock market rally and brand new news that shows the credit crunch is getting worse. So everyone, there's going to be an action-packed episode, so let's not waste any time. Let's get straight into the news, the facts, and the data. Okay, so first things first is this story run, and we've got lots to cover today, so you're definitely going to want to watch to the end. So Costco execs warns of looming recession because one change shoppers are making to their buying habits. So this one tweak that many shoppers are doing right now, and let me know if you're doing this down below, has been a very good indicator of a recession. So in a call with investors reported by Business Insider, Costco Chief Financial Officer Richard Galanti said he's seen some customers switching purchases of beef products to less expensive choices like pork and chicken. He's also seen this trend historically as the US enters into recession in the past. Now, you know what's very funny about the CPI and the baskets of good they do with the CPI report? What they do is they assume that, for example, if beef prices go up 20%, well, you're just going to start buying chicken or pork, like what they're saying here. So this hides the true inflation figure. And the most alarming trend with inflation is food costs are still at record highs and they're still rising. I go to buy bread. Bread is at least 300% more expensive than it was 5 years ago. Milk has doubled in price. Eggs have doubled or tripled in price. The basic essentials that people need to survive are still going up and going up by a lot. He added that some customers are purchasing canned meat and fish products which cost less and also have longer shelf life. In a situation of hyperinflation, or in the case of job loss sparked by recession, consumers who stock up on non-perishable items will be able to stretch their savings and unemployment income further if they already have well-stocked pantry. Now, this is something we've talked about extensively on the channel in the past, everyone. You want to get your food storage up to scratch, so that way, for example, like you want to have an emergency fund, it's also a good idea to have at least 3 months worth of food supply in case of any emergencies, kind of like a pandemic. That way you don't have to go to these retail stores when there's panic on the streets and people are fighting over toilet paper. A newly released report from United States Federal Reserve found that 64 Americans have switched to cheaper versions of products to make ends meet amid inflation. Meanwhile, 66% of those polled said they'd been using less specific products or eliminating them entirely. That report tracks with Costco's data in a few ways, showing Americans choosing less pricey products across the board. So this is a very good forward-looking indicator, everyone. I expect we're going to continue to see retail sales fall. Even if, for example, they're flat or go up 1%, it's only because prices are getting more expensive, not because people are buying more. And again, that's going to lead to companies' earnings falling, and with stocks being so overvalued right now, it's definitely going to lead to a correction once reality hits after this AI hype, and I'll go into details in a moment really why the stock market's rallying. He also noted that sales of Costco's private label brand, which sells for less than the national brands, has risen in the last quarter. But overall, Costco's sales have dropped by 4.2% worldwide and 3.5% in the US. A large percentage of that decrease, Galanti said, stems from consumers delaying big ticket purchases like TVs and refrigerators. So this is another sign that consumers aren't strong, everyone. They're not buying these big ticket items anymore. They're only buying exactly what they need because that's all they can afford, with real wages falling because inflation is much higher than the wage growth we're getting now. But this brings us to our lead story, but we still have much more to cover. So look at this, everyone. 50,000 retail stores to disappear by 2028 as shopping completely transformed. So what do they mean by transform? Or does it really mean they're going to destroy small business and mom and pop stores? The biggest declines are expected to come from specialty retailers, with clothing stores and consumer electronics making up nearly half of the total projected closures. Home improvement and auto parts stores, meanwhile, are expected to emerge relatively unscathed. So this many store closures would represent about 5% reduction from the current count of 940,000 stores across the US. It would also open up potentially $285 billion worth of consumer spending for the surviving stores to compete for and say. So I think we find the truth really why this is going to happen. This is going to be another $285 billion in revenue for these large giant stores, and they desperately want it. And if a recession comes, or what we're going to go over, if a credit crunch happens, we're going to see a lot of these big companies that have binged on debt. They're going to go bust, but there'll be those few surviving large retailers that are apparently too big to fail. They're going to take market share. And wait till you hear what stores they say that's going to dominate. So big box retailers like Walmart, Costco, and Target, our favorite retailer at the moment, are poised to win big under this scenario, while smaller chains and independent retailers would likely to continue their year-long decline in store count. The report says over the past decade, large employers have added 17,000 stores, while listen to this, while smaller ones have shuttered 40,000 locations. People, this is absolutely devastating. Large retailers have added 17,000 stores, while small businesses have lost 40,000 locations. Now again, you may think, well, this is no big deal. Well, what happened if one of these large retailers implemented a policy that you didn't agree with, and so you weren't happy with it and you wanted to go shop at another location? Well, you may not have that option in the future. So they say larger companies are better positioned to absorb the impact of rising rent, labor, and other costs, and stand to benefit from big investment in fulfilling digital orders in a way that small companies can't keep up with. Again, that's right, everyone. These small retailers, they can't compete when, for example, Costco can get these huge deals with these manufacturers and buy everything for much cheaper. And also when we have people's spending power getting destroyed, they're going to go to what's cheapest. And again, these small retailers can't compete. They warn in the coming years, if retail sales growth falls short of 4% per year, the long-term historical average, UBS said, the number of closures could reach 70,000 or more. So everyone, it's really not looking good for these retailers. And we got more reports that Target stock is continuing to fall. So that's right, everyone. It's now down to $133, down 18.5% from the recent controversy. Now, just very quickly before we get into this ridiculous jobs report that was released that caused the markets to boom, which is on false hope, I just want to thank everybody that signed up for those 20 spots for my pre-sale for my course, The Golden Path to Wealth, Mastering the Trinity Portfolio using gold, silver, and Bitcoin. I've got another 20 spots open. You can click the link in the description or the pinned comment. But now that's out of the way, look at this, everyone. So huge jobs divergence returns. Jobs added 339,000, but employment falls by 310,000. So they say here, and I completely agree, the BLS Wonderland reporting is back with a vengeance today as jobs and employment head in opposite directions and the unemployment rate jumps. Wow, everyone, could this be a reason why math is starting to fall in the US and around the world, why they don't want to teach you math? Because then they can just report whatever figures they want and say, look, people, we've added all these jobs, even though the unemployment rate just went up 3 points. And I've talked about how they've been cooking these jobs reports in the past, and it's just getting worse. So of the 894,000 rise in employment in January, 810,000 was due to an annual benchmark revisions, and the BLS does not say what months were revised. And if you want to pause the screen here and have a look at the jobs report details, you can now. So what industries were the biggest gainers? Well, leisure and hospitality added 48,000 jobs. Education and health services was actually the biggest gainer, 97,000 jobs. Government, again, big government getting bigger, 56,000 jobs. Manufacturing is actually fallen. They were down 2,000 jobs. Construction added 25,000. Retail trade 12,000, and professional businesses and services 64,000. Now again, the market thought this was great news, but the official unemployment rate rose to 3.7%. But in this report, they say the real unemployment rate is much higher, and I think we all know that. The U6 is much higher at 6.7%. Both numbers would be way higher still were it not for millions dropping out of the labor force over the past few years. Some of those dropping out of the labor force retired because they wanted to retire. Some dropped out over COVID fears and never returned. Still others took advantage of a strong market and retired early. Now, this sounds like a great thing. A lot of people retiring, enjoying their lives, and that is great. But unfortunately, what this is leading to is a huge demographic problem, and this is a massive problem for the West and for China. We have an aging population and not enough workers to fill the gap. He said, unlike many others, I expect the unemployment rate will not rise as much in this recession compared to the average recession impact. Unemployment due to baby boomers' retirement is another matter. So that's possibly why the unemployment rate during this coming recession may not go as high as past ones, because they simply don't just have enough workers. And that's why all these major economies, these aging economies, are trying to import massive migration. But also the way the government records unemployment is ridiculous. So listen to this. If you work 1 hour, you're employed. If you don't have a job and fail to look for one, you are not considered unemployed. Rather, you dropped out of the labor force. That's completely crazy, everyone, but it gets wilder. Looking for job opening on Jubal or Monster or in the want ads does not count as looking for a job. You need to actually interview or send out a resume. So these are all the new tools the government is using to make it seem like the unemployment rate is much lower than it really is. Now, again, this was music to the ears for the stock market, but what you really need to know is what's behind this rally is the AI hype. And really, there's only 5 companies that are actually behind this stock market that is rising at the moment. We'll have to see what happens in the long term, but really all the other industries are still lagging and lagging massively. So look at this, everyone. The S&P 500's gains are almost entirely from just 5 companies. So we can see with this chart here, the average return of the 5 largest companies of S&P 500. So we can see here, their return is actually 56%, while all the other remaining companies is just 8.9%. And this is from December 31st to May 31st. So which companies are exactly behind this boom? Well, the big 5 that are responsible for the mass majority of the stock market's 2023 gains are Apple, which is up 36% this year, Microsoft 37%, Alphabet 39%, Amazon 44%, and a current stock market darling Nvidia, which has surged 159% on AI related excitement. Well, everyone, if there's something we don't learn from history is we don't actually learn from history. Every single new technology that come out, there's always a mania and a frenzy. And yes, while AI will change the world, whether we like it or not, whether we think it's right or not, it doesn't mean you pay whatever price for it. Every single time there's a new technology, it always leads to massive bubbles. But listen what would happen to the market just without these 5 companies. So without them, the overall market, including dividend payments, would be up just 1.5% this year. Now, when you factor in inflation, it'll actually be negative. If you also remove the contributions from 2 largest tech companies, Meta up 120% in 2023 and Tesla up 66%, the S&P 500 will be slightly underwater for the year. So everyone, this is really why the indices are rallying right now. But if these 5 companies' earnings don't come in hot, we're going to see them fall, and that's going to bring down all the indices. Because look at this next major story you need to pay attention to. So Deutsche Bank warns the credit crunch will spark a wave of corporate defaults and a recession as tight financial conditions put an end to the lending boom. That's exactly what we've been warning about on the channel all along, everyone. We've been saying there's going to be a big credit crunch, there's going to be financial conditions tighten, and all these zombie corporations that could survive on cheap debt, they're going to go bust. Not to mention these big tech companies that have a lot of debt, they're going to have to pay more interest on that debt, and that's going to hurt their profitability. So in a research note on Wednesday, analysts pointed to the boom in credit that spanned the past 2 decades, with financial institutions ramping up lending as markets enjoyed ultra-low interest rates and steady economic growth. That's exactly right, everyone. The only reason why we've had this boom over the past couple of decades is because interest rates have only been falling. We've been in a rate cutting cycle, but right now we're heading into a prolonged period of high interest rates right when leverage is at all-time highs. They warned the onslaught of defaults appears to have already started, with US high-yield bond defaults rising to 2.1% from 1.1% last year, and loan defaults rising to 3.1% from 1.4% the year before. Now you may think 2%, 3% is not so much. Well, it is accelerating, everyone, and accelerating rapidly, and the trend is your friend until the end. At the peak, high-yield bond defaults could rise to 9%, they warn. Meanwhile, US loan defaults could rise to 11.3%. That's close to an all-time high of 12% seen during the Great Financial Crisis, though they warn the overall credit bust will likely be less severe than 2008, the bank forecasts. So it doesn't even have to be as bad as 2008, everyone. There's so much debt in the system, if it even gets close, we're going to see severe consequences. Our cycle indicators signal a default wave is imminent. The tightest Fed and ECB policy in 15 years is colliding with high leverage built upon stretched margins, analysts said, calling defaults a near-term risk over the next 6 to 12 months. He's right here again, because even though interest rates have only gone to 5%, debt is 4 times higher, or the US debt to GDP is 4 times higher than the 1970s when interest rates went to 20%. So even though it seems like interest rates are still low compared to the 70s, because debt is so much higher, every single rate hike has much more pain. Tight credit conditions are also signaling a recession is set to follow the ending of the credit boom. Deutsche Bank US credit recession gauge is flashing 35 to 40% chance the economy will enter a downturn, the highest reading since the pandemic. Well, I think we're actually already in a recession right now. And he's saying it's time to sell. Today, this model is increasingly telling us to sell, the bank analyst said. Wall Street has been bracing for a credit crunch since the collapse of Silicon Valley Bank this year, which set off a chain of lending failures that have caused other banks to pull back. Banks have already started to tighten up lending by the most they have on record per data from Morgan Stanley, which has in turn made a recession more likely in 2023. So everyone, I know we're thinking, well, okay, what does all this mean in simple terms? Well, what this means is we're going to see more retail failures, and there's only going to be a few large retailers left that will dominate the market and add whatever policy or agenda they want. What this also means, don't believe the job data they're putting out because it's completely cooked, and unemployment rate will continue to rise. And again, this credit crunch is going to lead to more defaults. That's going to hurt companies' earnings. Again, the only thing that's holding up the stock market right now is 5 companies, but once they get hit, it's going to bring down the whole Dow and the whole S&P 500. So you're probably wondering, well, okay, how can you protect yourself from this downturn? Well, it's not financial advice, but what I'm doing is I'm diversifying to gold, silver, Bitcoin. So that way, if there is a real recession, gold and silver, they normally perform well during recession. But hey, if there's not a recession and if there's actually a market melt up, well, Bitcoin, in my opinion, normally outperforms the stock market if there is a melt up. So that hedges myself against both scenarios. Now, again, if you're wanting to learn more about this, I have 20 spots left just for today for my course. It's half price because I'm doing a pre-launch right now. Once the course is finished, the price will be doubling. And when I did the first sales, they sold out very, very quick. But if you don't want to buy the course or you're not in position to buy the course, that's completely fine. Just watching, liking, and subscribing is more than enough. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.